Good afternoon, everyone. It's lovely to be with you again. As Chris said, a lot's happened in 3 months. And so, as I usually do, I will share some slides with you to help us just make sense of everything that's going on. I think the first place we'll start, let's get straight into it, is really the huge shift in expectations for where the RBA is going to take the cash rate over the course of 2026. And you can see really clearly on this slide that if we go back 9 months to August, that's the blue line on the slide there, effectively the market thought that the RBA would continue to deliver rate cuts in 2025 and that the cash rate would settle sort of somewhere in the low threes. Fast forward 9 months and you can see the market's expectation has shifted quite dramatically. As of today, that black line, the market thinks that the RBA is going to take the cash rate above 4.5%. And it'll stay there before possibly starting to ease off a little bit in 2027. So what's driven all of this? Effectively, just exactly what we say there on the slide. So if we look at the last maybe quarter or two of 2025, we had a strong pickup in growth. We started to push up against supply constraints sooner than everyone expected. Broader financial conditions were pretty easy. The cash rate had a 3 in front of it. Credit growth was really strong, both in business and mortgage lending. House prices were accelerating quite quickly. Equity markets were doing really well. And the global backdrop was certainly felt a little bit more benign than it does at the moment. And then if we sort of have a look at what's changed from February to now, it's really the energy price shock. So a lot has happened and you can see clearly a really sharp repricing in interest rate expectations. So just to make it really clear, you can see in the back half of last year how quickly growth started to pick up. And what you can see on that slide, which I think is really important, is that a lot of it was driven, especially those last 2 or 3 quarters, by really solid growth in the private sector. So consumption picked up, business investment picked up. We could see that contribution that data centers was making to business investment. And that meant the economy finished the year at a growth of 2.6%. The problem for the RBA is that that's above trend growth. Trend growth in Australia is probably only somewhere between 2.25%. And likewise, you can see that reflected in capacity utilisation. So we pushed up against capacity constraints, sitting well above long-run averages. So that's where we started the year. We also started the year with inflation higher than expected, both on headline and core measures, and importantly, it was broad-based before the energy shock. And so I think what is really important at the moment to understand is that the RBA is facing into what I would call compounding inflationary shocks. One is a domestic story, which is driven by capacity constraints binding, stronger than expected growth, tight labour market. And the other one is driven by global events, which is predominantly the Middle East conflict and the upward pressure that puts on energy prices, particularly oil. So what do we know as we sit in early May? I think one thing I wanted to share with you, we released these data just this morning, so they're hot off the press, so to speak. What we're looking at here is basically our own consumer spending data for the month of April. So this is the data that we compiled using the data we have for our own credit cards, debit cards, BPay. And so on the left, we've got the numbers for the month of April. On the right, we've got the most up-to-date numbers, which take us into the week ended the 2nd of May. So we track this data monthly, but we're also tracking it weekly at the moment. And so if we start with the chart on the right, what we're basically looking at there is the red line. And what it shows us is relative to the end of February, where the conflict started, discretionary spending on services, so outside of travel and accommodation, is basically flat. So that red line sitting at 100. And what that means is it's gone up and down sort of week to week, but basically relative to pre-conflict, it hasn't changed. So there is a story, I think, of underlying resilience so far in consumer spending, and at least that's what our data is telling us. If we have a look at the bar chart on the left, there's quite a lot of nuance to this, so I don't want to get too much into the details, but basically what it shows you is our own spending data for the full month of April was down 1.1%. That came after a really solid rise of 2.1% in the prior month. And you can see that it was basically, that fall was driven by quite a big fall in fuel spending. So that was down 6.5% in the month. That's, I think, largely a price story more than anything else. Food was also off 1%. And the reason why that was down in the month, that's quite a big move just for 1 month, was because what we actually saw in March was a bit of precautionary hoarding behaviour of non-perishable items. And so that was sort of unwound in April as people started to relax a little bit and didn't feel like they needed to stockpile food. The other one that's fallen a lot, which is distorting the numbers quite a bit, is that one right at the bottom, which is effectively travel and transport. And so this is being driven by a couple of things. So the fact that Victoria is running free public transport is playing a little bit of a role there. But a big driver of the weakness there is effectively refunds. So for a whole lot of people, maybe they've been planning to go to the Middle East or possibly onto Europe. When the conflict happened in March, some of those tickets couldn't happen, and travellers have received refunds. So that's dragging that component down. But what's interesting is that even outside of those two things, that component still looks pretty soft. And so we're not quite sure why that is. It seems odd that if you were going to curtail spending, you'd do it most dramatically just in that travel and transport series. But I think more broadly, what you're also observing in the month is that there are some discretionary spends that are still happening. So cafes and restaurants was up, household goods spending, other discretionary services up as well. And so what it's telling you, I think, is a bit like the chart on the right. Not everything is perfect in the world of the consumer, but they are certainly holding in, I think, reasonably well and suggestive of some underlying resilience there. The other thing that's pretty much hot off the press is the NAB business survey. We released that on Tuesday. We've seen a big decline in confidence in the last couple of months, although it bounced a little bit in April. But conditions were a bit softer too, which is not unsurprising given everything that's going on. And by state, what we're observing is some holding in better than others, but basically in all states, confidence and conditions have fallen over the last month or two. So unfortunately for Victoria, which is the black line on that chart on the right, it was doing much better through the back half of last year, but it's given up all of those gains just in the last couple of months. What we are observing, though, is that capacity utilisation is still well above average in many industries. So the chart on the left is just showing you the black dots are sort of the long run average. The red bars are where we are as of April. And you can see in most industries, we're either at or above long run averages. And so what that's telling you is that this is still an economy that is pushing up against those capacity constraints. The chart on the right shows that capacity utilisation's come off a bit, still sitting well above its long run average. Probably the most striking charts and the most striking story, I think, in the NAB business survey is what's going on with costs and prices. So just have a look at the chart on the left. This is purchase costs in the NAB survey. So we asked businesses to basically tell us what they think their purchase costs have gone up by, or their input costs. And you can see, pretty large jump in COVID. Mostly month to month, we don't pay a whole lot of attention to this series. It doesn't tend to do very much, but that is an eye-watering move in the space of just 2 months. And what that does is really sink, and I'm sure many of you are also hearing this from your business customers, this really syncs with the anecdotes that we're getting from our business customers at NAB, who are constantly telling us that their suppliers are saying to them, we've sent you the invoice for maybe March or April, but we're just letting you know that when the next invoice lands, you're going to see sort of plus 20, 30% on some of the inputs into your business. And so this, I think, is a pretty worrying sign all round, especially because the other signal that we can take from the quarterly business survey is that margins are not that robust. So if you look at the chart on the right, they're better than they were at the beginning of 2025, but they're certainly not as robust as they have been in the past. And so what that tells us is that most of these firms don't have the capacity to absorb these large increases in purchase costs. And so unsurprisingly, when we have a look at prices, so what are end customers paying, the chart on the left there shows you what has happened to output prices or final prices in the retail sector. So again, pretty stratospheric jump just in the space of 2 months. Now, this is going to worry the Reserve Bank, to put it bluntly, and it's going to worry them because already before any of this started to happen, if we have a look at the chart that's also up there on consumer inflation expectations, what we've been seeing is consumer and also business inflation expectations, for that matter, drift higher even pre the Iranian conflict. And that worries the RBA because it's making them concerned that we are going to possibly see what is quite a broad and rapid dissemination of second round price impacts on domestic inflation. And that's already on top of a starting point that wasn't ideal for all of this. So this is sort of turning into, I think, quite a challenging situation for the Reserve Bank. Before the Iranian conflict, inflation was too high and rising. And then what we load onto that is a challenge from basically the rest of the world, or particularly the Middle East, which has driven up purchase costs. It's starting to be reflected in higher output prices, and that's against a backdrop of rising inflation expectations. So I think what that means is the Reserve Bank's going to hike rates again. We're expecting that to happen in June. That's not really priced by the market. The market thinks that it's more likely to happen in August. But I think, what this story tells me when I look at it is that the Reserve Bank probably doesn't have time on its side. And a customer asked me at an event I was doing down in Adelaide earlier this week, do you think it's possible that the Reserve Bank might make a policy error in the next couple of months? And my answer to them was effectively they've already made the mistake. And the mistake was not making sure, with the benefit of hindsight, that they were really on top of that inflation problem at the end of 2024 and into 2025 before they cut rates. And so I feel like they're maybe having to just sort of rush a little bit on all of this. And that's why we think there is a sense of urgency to what's going on with the recalibration of monetary policy. And that's why we think they'll be up for another hike as soon as June. So that's monetary policy and the challenges there. If I look at our forecasts and I think, where am I going to be wrong on that? I'm probably more worried that the bank has to go more than just one more time. But for the moment, we're just sort of having to play it a meeting by meeting, just largely because, as Chris alluded to at the top, it's pretty difficult at the moment. On top of that, we've also had a budget this week. There's a lot going on in the budget. So maybe just in the last 5 minutes, I might just quickly run through our take on that. Effectively, what we can see here is quite a few things, but if you focus on the black dotted line, that's what the government is forecasting for the underlying cash balance for the next 3 to 4 years. So basically still deficits. The grey bars are what the government thought that budget balance would look like as of Christmas last year. So when they released the mid-year economic and fiscal outlook. And so you can see, if you look hard enough, that there has been a little bit of an improvement. The grey bars are a little bit more negative than the black dotted line. And that's basically because there are a few things that go on with the budget. You get, because we've had better growth, tighter labour market, we get what we call positive parameter variations. And they're the blue bars that you see there. So that's effectively the extra revenue the government's getting because they're getting more tax revenue from workers and PAYG tax, and they're also getting more tax revenue from commodity companies as commodity prices go up. So that helps. And then the red bits are policy decisions that they've taken. So what have they done to either improve or worsen the budget bottom line? And you can see that the red bits are smaller than the blue bits, and so that's how you get the improvement. If you look at that final out year, sort of 29-30, you can see that the red is actually adding a lot to the budget bottom line. So big improvement there. That's effectively NDIS. That's what that big jump is. So the government got windfall from a better economy. They didn't spend it all. That'll make all else equal the Reserve Bank a little bit happier than it might otherwise have been. But I would say that even in that space between Christmas and this week's budget, there was still $18 billion of new expenditure announced over the space of 6 months. The problem we have in Australia is that our budget remains in structural deficit. So, one of the ways you can decompose what's going on in the government's fiscal situation is to look at what role the economy is playing, what role underlying fiscal settings are playing, and that's the red bars here. We have a structural budget deficit. It's not big, it's about 1.5%, give or take, of GDP this year. But what it does mean is that we need to get that fixed, because if we don't fix it, it means it's really hard to run budget surpluses. And so it is quite remarkable that even in a time of reasonably strong economic growth, a really tight labour market, we're still managing to run, reasonable budget deficits. That's not what we want. And so what that tells me is that there is still a lot of work to be done on fiscal repair. We've got to find ways to cut back expenditure. We've got to lift productivity growth, and we've got to get the structural budget balance back into surplus. Just in terms of what is fiscal policy doing to the economy, we can look at the budget from the perspective of what we call the fiscal impulse. So is it adding to growth? Is it acting as a bit of a headwind? You can see just in the last year, basically the budget was pretty supportive of growth, a little bit shy of 1% of GDP. And as we move into 26, 27, that becomes broadly neutral. So again, it better aligns with the stance of monetary policy. I think at the moment, the budget is not making the RBA's challenge a whole lot worse, but it does mean that we will have a bit of a tightening in fiscal policy as we go forward. In terms of fiscal dynamics, this is an interesting chart, because what it's basically showing us is the little dots you can see there is basically the annual growth rate in the big expenditure categories in the budget over the medium term. So what we're saying is that over the medium term, NDIS is going to grow a bit below 8%. In 26, 27, the budget is forecasting that to grow a little bit less than 4%. But have a look at the one right at the other end of that chart, which is effectively interest payments on the debt. That's going to grow at over 10% a year over the medium term, and it'll grow, somewhere between 8 to 10 in the next financial year. So that is now the biggest expense with the biggest growth rate in the budget. So this is a reason why we need to do something about the structural budget deficit. And then, of course, we move on to the reforms. So as Chris said, I think one of the biggest, or the most consequential budgets in probably a quarter of a century. The reforms came in largely as pre-announced, so there wasn't really much in the way of surprises for us on Tuesday night. Effectively, the government is removing negative gearing, except for new homes going forward. It's grandfathered existing arrangements, and the CGT regime is going to move away from that 50% discount to an indexation framework. But if you invest in new builds, then you've got the option of choosing. So effectively what the government is doing, and part of the issue with these tax arrangements is not each one on its own, but it's the combination of the two that have made it basically very attractive to leverage into effectively low yielding investments, and to basically construct for yourself in a call option on the capital gain. And so the fact that we're taking that incentive away at the margin, I think, is a good thing for broader financial stability, but it probably will likely mean a slightly softer outlook for house prices in the near term, and it will put upward pressure on rents, just simply because we have super low vacancy rates in most capital cities. So these are really consequential changes. They will matter for equity markets at the margin. It makes you want to favour income stocks over growth stocks. And I think in the housing market, it certainly presents people with a pretty attractive opportunity to leverage up into their place of primary residence, because that is the one asset that is free of CGT indexed or otherwise. Government tried hard on housing supply. So that's a good thing. The problem is, construction is capacity constrained. Out of all the industries we survey in our business survey, that's the one that comes up where respondents consistently tell us it's really hard to find skilled labour. And so it's all great to do this stuff, housing supply, but if you can't build the houses because you don't have the people, then it doesn't really lead to very much. What could have been better in the budget? There was nothing really in there for business investment. So there's a little bit of stuff in there around the treatment of tax losses that'll help with cash flows. But broadly speaking, we've got far too much reliance on income tax. And while there was a list of things that the government has done on productivity growth, and they're all positive and they're all good on their own, but they are incremental at best. And so I think we know that because the government didn't lift its forecast for productivity growth. But really, the one thing that's going to make the biggest difference to standards of living and housing affordability is actually boosting real incomes, and we can only do that if we do more on productivity growth. So there's still, I think, a long list of things that could have been done there, but maybe we'll get lucky on that in a year's time.